All right, folks, we are going to get started. I want to be respectful of your time, so thanks so much for joining me today here. Just a little bit of quick housekeeping. We are going to do some questions and answers at the end if we have time. What I'm asking is to please, if everybody doesn't mind, putting their questions in the Q&A. I'm a party of one, so I don't have anybody working with me. So I'm not going to be looking at the Q&A until the very end of the presentation. So I just wanted to let everybody know. So don't think that I'm ignoring you. Being here by myself, that's the way that I'm going to handle that. So, well, thank you so much for joining me here today. My name is Jen Vale. I am an associate director with Civitas Strategies. I really do appreciate everyone joining us. We are recording this presentation. I know that Creaser will have this available for viewing. So I want to thank them so much for having us, as well as the New Mexico Early Childhood Education and Care Department. We are very happy to be here today from Civitas. And Civitas Strategies, we work with child care providers nationwide to help grow and strengthen their businesses. So we do that through presentations like this today. We do it through guides and videos, one-on-one coaching. So we really do appreciate you joining us today. And today we're going to talk about taxes. There's a lot of information to cover. So we're going to go ahead and talk about taxes and how we've got a little tip for how you can actually even mitigate last year's taxes. So that's somewhat unusual. Most people don't know about that. So let's get started. We're going to do a quick disclaimer. So the information that is contained here has been prepared by Civitas Strategies on behalf of New Mexico Early Childhood Education and Care Department, West and Growing Up New Mexico, and it is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information is not intended to create, and receipt does not constitute an attorney-client or any other advisory relationship. Reproduction of this information is expressly prohibited, and it is only meant for non-commercial use. All right, so what are we going to talk about today? We've got a lot of content today. It may run over the hour. Of course, if you just need to jump off, by all means, I understand after that hour, but we may run all the way into an hour, 15 minutes or so. So what do we want to talk about today? We're going to be covering several important tax topics that can help you run your childcare business smoothly year-round, not just during tax season. So a lot of what we're going to speak about today are things that you can implement throughout the year to have a very successful tax season. So first, we're going to discuss why you should care about your taxes throughout the year, not just on April 15th. We're going to explain what a Schedule C is, just in case if you're not familiar. We'll talk about how to use it to report your child care business's income and expenses. We're going to go over some steps that you can take now or throughout this year to get prepared for next year's tax season. And then we've got a little tip about how you can actually mitigate the 2023 taxes. There's a little something that I find quite exciting that we can do to actually affect our 2023 tax bill. So the goal today is to provide you with tax knowledge to optimize your filing and minimize headaches when tax season rolls around. Please keep in mind, this is not meant to be any type of tax preparation. This is for educational purposes only. So we are not tax preparers, but we are sharing the information that we've learned that helps childcare businesses. All right, so some very important reasons why you should care about your taxes. The first one is profit retention. So while it's the responsibility of every business owner to pay their fair share of taxes, right, we have to do that. proper tax preparation can be a vehicle to help you recapture your hard-earned profit, and it can keep more money in your pocket, right? So that's very important. And if you understand the allowable expenses, that results in you legitimately paying less taxes and retaining profits. So that's fantastic. Next reason you should care, risk mitigation. All right, so education is key when it comes to understanding allowable expenses and how to properly prepare your taxes. So the more that you're aware of tax rules as they apply to childcare businesses, because they can be a little different, the less likely you are to trigger an IRS audit. And audits are very time consuming. They can cause distress, a lot of stress. And at the end of an audit, often it can be very costly because the audit may result in you owing money that you weren't prepared to pay, right? So we want to care about our taxes so that we're not worried about, we're basically mitigating risk and not worried. Another great thing about caring about your taxes is that it allows you to understand your business's health. And basically, as you review your taxes and you think about tax time throughout the year, you're getting a really good handle on how healthy your business is, right? So having an accurate account of profit really allows you to understand the financial position that your business is in, and it can help you plan for changes going into the future. Another reason is to build business confidence, right? So we said knowledge is key, and having the confidence in knowing that you're properly claiming deductions, that you've met your tax obligation, right? That removes any factor of the unknown. And really understanding taxes really well, it gives you the ability to continue to operate in a mindset that you are following the rules that are set by the IRS, and you are unlikely to have any type of unforeseen debt or potential future problems. So a lot of great reasons to care about your taxes. All right, so at Civitas Strategies, one of the things that we do is we work with childcare providers to help them analyze previous year taxes and figure out what they can do for the upcoming year. And we did a study, so we were working with childcare providers, and we did some research, and we worked with a certain number of providers, and we did some research through working with their tax returns. And that research on those taxes, it illuminates several findings. We find that these actually track with business owners that we have continued to work with, so and that we work with every day. So there are a couple things here that are concerning. So in our study group there, 83% of the home-based childcare providers that we were working with did not claim business use of home at all. Right now, we know the IRS allows for those deductions. You use the Schedule C, line 30, business use of home, and you can take the deductions associated with those costs, but we found 83% of the childcare providers that we reviewed and worked with did not claim those expenses. Now, something that's truly, truly sad, right, is that in some cases, some of these providers did not claim any expenses on their taxes at all. So it should never happen, right? Every dollar is important to reinvest in your childcare program. And undoubtedly, childcare businesses are going to have deductible expenses just to operate, right? We know that. So there should never be an instance where a provider is unable or to find or unable to claim legitimate expenses that are associated with their operation. So we know that the Schedule C, IRS's Schedule C, that's where you would list all of your expenses, and it has many, many categories on it. So, and we encourage you to really grab a Schedule C, which we're going to look at today, go through each category, think about your qualifying expenses, and that way you can lower your tax liability. So important that, you know, our research uncovered that. Another area of concern was that many providers were claiming invalid business expenses, which could drastically increase their chances of an expensive, time-consuming IRS audit. So we always obviously advocate claiming valid expenses, right? So the keyword there is valid. So there are expenses that you may have that are not valid for your childcare business. And those expenses that are not allowed can automatically trigger audits. They can raise red flags. So the rule of thumb with the IRS is that this is basically what you want to remember when you're thinking about expenses, all right, is that the IRS considers a valid deduction slash expense to be ordinary and necessary required for operating your business, all right? So basically, the IRS knows what type of business that you have, and they review your expenses to see if they're appropriate based on your business type. So they actually are looking for appropriate expenses for childcare businesses. And then something else that we found that, what we want to do is make sure that people's taxes are exactly as they should be. And something that we found were that several common deductions were either miscalculated or they were miscategorized. So they were put on the wrong place of the Schedule C. And when that happens, that's another opportunity that there may be a red flag and an audit alert there. So the deductions can be valid, but if they're in the wrong place on the Schedule C, it can cause a problem. So an example of that we find happened over and over again were children's meals, all right? So we found that many of the providers were deducting children's meals using the line on the Schedule C that says deductible business meals. But the IRS intends for that line to be used for business expenses while traveling, for meals while traveling on business, not for children's meals. So understand that high expenses in the wrong category can prompt an audit, even if unintentional, right? So even if it's an allowable expense, if it ends up in the wrong place on the Schedule C, you may have an issue. All right, so what is the Schedule C? So we know that there are a number of different tax forms, right? We're all familiar when if someone prepares our taxes, we get to see all the tax forms. Now, the income for a sole proprietorship or single member LLC is reported on the Schedule C form as part of your personal 1040 return. Now, if you have more than one business and they're not closely related in nature, you'll actually have more than one Schedule C with your taxes. So an example could be you have your childcare business, but you also have a craft business on Etsy, and maybe you drive for Uber and Lyft. Those are separate Schedule Cs because we have businesses that are not closely related. So we would split that up there. Thinking about the Schedule C, when the first thing that you do is you report all of your revenue, right? So all of the money that you receive from the business. Then you show all of your expenses, the things that you paid for to keep your business running smoothly. And then you calculate the amount that remains, which if it's positive, you made a profit. And if it's negative, you had a loss, which we don't want to have happen. All right, so here's a picture here. We have the Schedule C up. So basically, let's take a little closer look at what do the different sections mean for reporting data for your business. So now, if you use tax software, it will actually walk you through these different parts. So let's say you use TurboTax or something of that nature. It will actually walk you through the different parts of the Schedule C. So if someone else is preparing your taxes, they may be familiar with the Schedule C, but it's very important that you as a childcare business owner basically be familiar with it, understand how it works, what's listed, and be really comfortable in having a conversation with your tax preparer about what's on your Schedule C. So very helpful to know your way around this document, even if you don't prepare your own taxes, or if you use something like TurboTax. So part one, very, very simple, right? It's where your sales are all total, all that income. There's also a line there for cost of goods, but I will tell you in childcare, very rarely is there actually a cost of goods expense. So that's, for the most part, when we see childcare tax returns, there isn't anything listed under cost of goods sold. That's usually not the case there, but basically all of your sales are there in part one. And in part two, it's where all the business expenses are reported, right? And like I said, there are a lot. There's over a dozen categories that you are listed there to help you stay organized. There's advertising, car and truck expenses, legal and professional services, travel and meal expenses, other costs that you may have there. And then once we've run through that, that last section is where the profit is calculated, and that's line 31 on the Schedule C. So we take all of those expenses and we subtract them from all of that revenue. So part two gets subtracted from part one, and then that's the net profit. And keep in mind, as a sole proprietor or single member LLC filing on a Schedule C, line 31 is considered to be your net profit from self-employment. And that number on line 31 is what you pay the 15.3% self-employment tax on. It's on that number. So what I'd like to do next is, we understand the Schedule C. Let's talk about how we can basically proactively prepare for tax season to avoid headaches down the road. So we're a little late in this tax season, but we do still have time. We do still have a few weeks. So there are things here that hopefully you'll be able to use, but I'd also like you to keep them in mind for the next tax year. Now, what we're going to do when I get to the question and answer period, I'm going to include a link to the Civitas Strategies website, and that website will have all of the tools you'll see that you can click on. So all the tools I'm going to discuss today and the links I'm going to discuss today are on our website, and I'm going to give you the link directly to that page for these tax resources. So the whole idea of this, right, is to help you avoid headaches, to be prepared like a pro, because it honestly, proper tax preparation is key to helping you tackle this and manage tax season and make it far less stressful. So here on your screen, what you see is the Homegrown Preparing for Tax Season, a guide for home-based childcare providers. So this is something that Homegrown put together, the Homegrown organization put together with Civitas Strategies, with the company that I work for. And the whole purpose of this guide is that it aims to help home-based childcare providers optimize their tax preparation and maximize deductions. So there are so many. This is like the absolute key guide, key means of having a resource for home-based childcare providers doing their taxes, because what's in there are record-keeping best practices that you can implement now, tracking income, expenses, mileage, business use of your home. You're going to use that record-keeping throughout the year and years to come. There's a section that goes more in depth about understanding the Schedule C, about capturing the income, all of the income, the different types of business expenses that are there. It talks about how the business use of home deduction works, which includes calculating and documenting time space, because a lot of people have questions about time space. There's a section there that will talk about some of the larger expenses that you have: supplies, meals, utilities, repairs, goes into that. There's a spreadsheet that we're going to refer to that basically there's a digital link in the workbook that takes you to a live spreadsheet. One of the tabs on that spreadsheet is to help track mileage. So if you're not using an app or anything, you can use this this tab that has a mileage tracker in the guide. So that's fantastic. It talks about depreciation, and depreciation is something that often childcare providers are intimidated by or get a little confused about. So it addresses depreciation. It talks about taking advantage of the qualified business income 20% pass-through deduction, which we're not going to talk about today, but you can find more information about that in the Homegrown guide. It actually has a section on business structure, right? So LLCs versus sole proprietorship. And those are questions that I, as a business coach, get a lot. People asking about what their business structure should be. So in the guide, there's information on that. And then it gives you all of these proactive tax steps that you're going to take throughout 2024 to maximize next year's return, right? So in that guide, there are checklists, visual examples, walks you through every step. So it's a great means of support for childcare providers, especially home-based. I will say sometimes we have people who operate centers who go take a look at it and say that they found something they didn't know. Obviously, the Schedule C doesn't apply to them, but it could be record-keeping processes. It could be just looking at lists of expenses, depreciation. So there are things that centers can also benefit from with this guide there. So what's nice about it is it has actionable steps. All right. So it really has things that walk you through that allow you to take action to really improve tax season and how you address taxes throughout the year. So I have a QR code here on the screen. You can see that the website link is here, but I'm also going to include that link to our Civitas Strategies tax page because all of these resources are linked there. So we're going to do that towards the end of the presentation. All right, so when it comes to understanding your taxes, it's all about what you made and it's all about what you spent, right? That's what it comes down to. So that first section on the Schedule C, right? All about revenue, how much money that you made. And if you have an accounting system, getting that information is easy if you've been entering it properly. But if you don't have an accounting system, in the Homegrown Guide, I mentioned that there's a link to a worksheet, not a workbook, but a Google Sheet basically, that has different tabs on it. And one of the tabs is a revenue worksheet. So what's great about that is that you'll be able to use that sheet if you don't have an accounting system. So what you want to do right first is start by gathering all of your records. So we know that you're going to most likely have 3 different types of records for revenue. One, 1099 forms. So those are evidence, right, that another business paid you for services. So home-based businesses are very familiar with the 1099 NEC for subsidy payments. Also, you receive those for participation in the Child and Adult Food Care Program, Child and Adult Care Food Program, the CACFP. And you may also receive 1099-Ks in reference to payment apps like Zelle, PayPal, Square, things of that nature, Venmo. Right now, I will just tell you, everyone had heard throughout 2023 that they were going to be receiving these 1099-Ks for any payments they received through payment apps for $600 or more. So just to let you know, in November, the IRS decided to change that rule. So for 2023, you weren't receiving 1099-Ks unless you had over $20,000 in these paid to you through payment apps. Very, very rare that child care providers would have received 1099-Ks in 2023, but those amounts are going to change in 2024, 2025, 2026. So what you're going to want to do is check out the IRS website just so that you're prepared that you're going to potentially receive these 1099-Ks next year for your 2024 taxes if you have enough revenue through those payment apps there. Now, another source would be your bank records, right? So basically, those will show funds that you received, so deposits that you made. You want to gather all of your bank records and then any of your own documents. So maybe you have the receipt stubs for what parents had paid you, things of that nature, right? So we want to go through and we want to do our own documents. We want to make sure we pulled all our bank records and accounted and brought together every 1099 that we've received. Now, this is an example of that revenue worksheet. There is that link in the guide that takes you to a digital version of this so that you manually aren't handing them out, right? Filling it out, excuse me. So that's the next step would be you've gathered your revenue. If you don't have an accounting system, if you aren't pulling reports from the accounting system, use something like the worksheet, right? I believe it's on page 7 in the workbook in the guide. And once again, you'll be able to find that link on our Civitas page there. So as you go through whichever method you're using, right, and we include the revenue for every child that we care for, and any of those 1099s that we've received, also anything that you've any income you've received for grants, maybe those aren't on 1099s. Remember, you do have to declare that as revenue. I want you to keep in mind, right, that if you received reimbursement for food costs through the Child and Adult Care Food Program, you're going to report all of those reimbursements in the income section of Part 1 of the Schedule C. But remember, you also are then deducting the food costs on Part 2, where you're listing all of your expenses. So sometimes people get a little concerned and they say, oh, I received all this money. Just keep in mind, the food expenses are going to be deducted. So, don't be off put by having that. All right, so once we've gotten all that income together, now we need to think about our expenses, right? So we have to collect any documentation that we have that we spent money on for our business. So you want to make sure that you have records of all your costs, right? So receipts that show payment for expenses. You can often use canceled checks, invoices, credit card and bank records, but every expense needs to show that you paid the expense, that it was paid, the amount that you paid, the date that you paid it, and there needs to be a description of the item purchased or the service received. So, again, you'll see that we'll go next. Let me just jump over to this is the expense worksheet there. So if you don't have the accounting system, you would be able to gather all of your expenses and put them in the worksheet that is found on the guide, right? So you just go month by month through all of your records, right? You look at your credit card bills. You look at maybe you paid people in one of those payment app services, right? So maybe you paid for something through Venmo or through Square Cash or something like that. We'll go through the bank statements, the checks. We'll make sure that we have an accounting for any cash that we received, because remember, we need to include that. You obviously, as a business owner, want to have a very good way of tracking your cash receipts. Again, we have to claim that. We have to pay taxes on it. So once you've accumulated and gathered all of that documentation, then you can go to a worksheet like this. And basically, these are all of the categories that are on a Schedule C. So again, home-based childcare providers, great, but a center might want to take a look at this just to make sure that expenses are triggered. They're remembering things there. So basically, if you have a home expense, right, if it's directly related to your business, it would be included in these expenses in this table, but it has to be a direct expense. And the IRS defines a direct expense as one that is incurred exclusively for the business and provides no personal benefit. All right, so when we think about a direct expense, we're thinking about, for instance, fixing a bathroom that's only used by the children, getting a new rug for the children's play area that isn't used by the family, playground equipment that isn't used by the family. Now, those are direct costs. Indirect costs are any of the costs that are associated with your home that's shared between home use and business use, right? So those types of things would be homeowners insurance, utility bills. So where you're going to think about the business use of home, because that's where you take the time space calculation into consideration. We're going to go into depth into all of that. Now, I want you to keep in mind that you should be holding on to the proof of payment so that you've paid everything through tax season. Hold on to it through tax season. Hold on to it for at least 4 years after. You may, if you have paper copies, you may also want to take a picture with your phone, put it in your notes folder in your phone, scan, whatever, but it is a really good idea to have proof of your expenses should the IRS ever ask for them. So always a good idea to have that. All right, and when it comes to taxes, there actually are a couple categories that are considered to be somewhat tricky. So these are categories that a lot of childcare providers have come to us and said, I don't know the right way to do this. Am I working with this the proper way on my taxes. So let's start with vehicle. So automobile expenses are something that can be a little confusing at times, all right? So what you see here, these are the elements that you have to make sure that your transportation is deductible, right? So it needs to be in the regular course of doing your business. It has to relate directly to the child care, which could be like picking up the kids. It has to be business related if you're making a trip. So keep in mind that when you're looking at all of your mileage and you're thinking about your vehicle expenses, keep the personal mileage and the travel, the business travel mileage separate, right? So anything that we're doing for business, we want an accounting of that. And we're going to talk about one way that one method of reporting your vehicle costs that's actually required. So, all right. Business trips. All right. So when it comes to business trips, and I don't mean going on vacation, not vacation. I don't mean going to a seminar. Just the day-to-day trips that you take. Just keep in mind that a trip could be for both business and personal, but it's only deductible. That mileage is only deductible if the primary purpose was for business. So let's say you go to Costco and you have a big long list of things for the childcare business, but you pick up a jar of pickles, you pick up something personal for the family. That trip is still a deductible trip, right? Because supplying your business was the main reason that you went. That's allowable mileage as a business expense. But if you went to the grocery store for all of your own groceries and you happened to pick up an item that was needed for your child's care, that trip is not deductible, right? Because personal errands were the primary driver to you taking that trip. So what you're going to want to do is think about, was the trip necessary in the first place? Was the main purpose business? And again, right, if there's a little bit of personal in there, it could still be if the primary reason was for business there. But if it's personal, you're not going to include that. It's not qualifying as a business expense. Now, when it comes to calculating and deducting the cost of travel, you obviously can use the vehicle for childcare. You're wondering how you go about deducting that on your taxes. And there's two different ways that you can actually claim the expense. We're going to start with the actual method. So the actual method, exactly what it sounds like, you capture all costs associated with the vehicle. So that would be, you'd be tracking mileage, keep that in mind. You will track mileage in both of the methods. You basically, there's a lot of record keeping with this because you have to keep every receipt. You have to keep every gas receipt, every repair receipt, anything having to do with the automobile, and then only claiming the deduction for the amount that was used on business. But with the actual method, you have to very carefully show your personal and your business use. So you're not just thinking about the miles that you drove for business, you also have to show, if the IRS were to ask, you have to show them all of the miles that you used your vehicle for personally. So there's a lot of significant time to collect and get all of those receipts. But I will say that the actual method does often result in a higher deduction, right? And especially if your vehicle is used exclusively or primarily for work, the actual method can get you a higher amount of an expense there, but needs really careful record keeping, all right? So, and that's for both your business and your personal use. So that's the actual method. Now, the next method is the standard mileage rate. So this is set by the IRS. It simplifies the tracking. You still have to have a detailed log of the business miles that you drive, but you don't track the personal miles. So, and keep in mind, right, that there are many different apps, some of them either free or very low cost, that can help you track your mileage. And the pros of this is that there's a lot of ease of calculation. In 2023, the IRS rate per mile was 65.5 cents. That includes everything, all of the expenses. That 65.5 cents is not just meant to cover gas, but it takes everything into consideration, right? So we either do the actual method of reporting our automobile expenses, or we use the 65.5 cent IRS mileage rate. So that's a lot easier to keep track of than the actual method. What's interesting, is that the IRS actually, even though you're using the fixed rate by the IRS, sometimes it gets greater scrutiny. You want to still make sure that you're maintaining all of the records for this business use of your vehicle. Now, you're going to keep, for the actual, you're going to be keeping a log that, and really for the standard mileage rate too, think about what's in that log. So you do still need to have the date of the trip, the amount of miles that you traveled, the location you were going to, and the purpose for the trip. If you're doing actual, you're doing exactly the same thing for your personal, that you're going to want to at least keep track of the number of miles, but actually they want to see as much information as possible. So again, if you are able to carefully track both business and personal, the actual method may be to your advantage. If you just prefer to track the business, keeping in mind the date, the reason for the trip, where you went, and then the actual mileage, the mileage option may be what's best for you. You cannot jump around, so you cannot claim the expense one way one year and then jump the next year. They're looking for consistency, probably looking for 5 years or so of consistency. What might be a good idea is if you're not prepared to do it for the 2023 tax season, think about for 2024, maybe calculate, save all the receipts, track all the mileage, personal and business, and then compare the two methods and see what's getting you the larger expense, excuse me, and what's better for you based on the amount of record keeping. So keep that in mind. So by doing that, you can decide what works best for your taxes. So the next tricky topic that providers often ask us about is, how do you handle deductions for food and meals, right? So I want you to keep in mind that food for the children is fully deductible. There are two exceptions to food that may be involved in your business that are not fully deductible. The big question that we always get from providers is, okay, I know about what is deductible, how do I do it? So we're going to go into that. But so keep in mind, right, the children in your care, fully deductible, their meal costs. If you are feeding your staff, only 50% of their meals are deductible. And if you're caring for your own children, even in the program, their food costs are not deductible. So those are the differences between what is and what is not allowable. Now, just like with the vehicle, there are actually a couple methods, two methods that you can use to deduct your food expense. And one is actual expenses, and one is what's called the standard meal rate. So let's take a look at those. All right, now the actual expense that you see here, the actual expense method, actually is what childcare centers have to use. Home-based businesses have the option of using either actual expense or standard rate. So just keep that in mind. So what is the actual expense? Exactly what it sounds like. 100% of the actual cost of food that's consumed by your daycare enrollees. And then again, only 50% of what your employees are. If you're feeding your employees a meal during the day or meals, only 50% of that would be allowable. Keep in mind, when we talk about employee meals, we're not talking about parties and special things. If there are special benefits that you're giving them that they don't have to claim on their taxes that are food related, those could be included as a business expense. For the 50%, we're talking about the meals day in and day out that your employees may consume. So how do we go about doing this? We have to keep track with the actual method of every food expense, right? You keep the receipts for everything. The pro to that is that you're going to get that money back as a tax, as a deduction. It's an allowable expense. But keep in mind, the con of doing that There's a lot of recording burden, right? So there's a lot that goes into tracking all of that food expense. And there can be greater scrutiny with the IRS. So we just like to keep that in mind. But remember, if you're a center, you do have to use this method. Now, if you're a home-based provider, you do have the ability to use this method that is requires less record keeping. So it's called the standard rate. And what basically it is that it's used for family daycare providers that allows you to compute the cost of food in an easier way. How is it done? So basically what happens is, as a business owner, you're going to keep track of the meal types, the number of meals, and then you multiply those different meal types and the number of meals by a set amount. And the set amount is the tier 1 of the CACFP program. So the tier 1 reimbursement rate is what you would actually be multiplying meals by that number. You don't have to be enrolled in the CACFP to use that rate. That's basically any homely childcare home-based family provider would need to use tier 1 if they would like to use this method. All right, so it's easier record keeping. It definitely is. And if you have any types of meals or snacks that aren't included under that, we'll go over what meals are included there, you can be reimbursed for those as well. You can still claim those as an expense. The con, there's still record keeping, right? So what you would want to do is keep the name of each child, the dates, hours of attendance, number and types of meals served. So you're going to want to have a nice record keeping system this way. So this method, it is simple in the fact that the actual calculations are easier, right? So with the tier 1 CACFP method, the standard rate method, you are allowed a maximum of 1 breakfast, 1 lunch, 1 dinner, and 3 snacks per child, per eligible child per day. And that's different than other CACFP reimbursement allowances, right? Which can be 2 meals and a snack or 2 snacks and a meal. So using the standard rate, tier 1 of the CACFP, you can claim more meals and snacks than you would often under the standard CACFP if you're a member, if you're receiving reimbursement from that program. All right. Another tricky topic are home expenses, all right? So this is kind of where I think some child care providers get a little worked up and a little concerned about this. And we do see mistakes on Schedule C's and what is called the 8829 form. We do see mistakes and some confusion surrounding there. So basically what it is, right, is we need to figure out how much of your expenses are related to business entirely, and how much of your expenses are involving the business use of home. And that business use of home is where we use time space. And actually, we're going to walk through 6 very easy steps to determine your time space calculation, right? So the space portion of time and time space calculation means that you have to think about the space in your childcare program that is exclusively used for childcare and there's no personal use whatsoever. That is called exclusive use space. But we're also need to measure then all of the regular use spaces, right? So those are the areas that are used by your family as well as your childcare business, right? So maybe the play area is in your basement, but your family also uses the basement. That's a regular use space. Maybe we have something for our childcare business that is not used at all for business. It could be for personal. It could be a closet that's all supplies. It could be a room where only the children are cared for and there's no family use of that. That's an exclusive space. So those exclusive spaces mean that 100% of the time that they're used only for the business. You do want to be careful because the IRS reserves the right to come in and inspect your home. Kind of crazy, right? But 100% of those expenses are going to be deductible. The regular use, right, means that you use that space for your program on an ongoing basis, one or could even be just 1 or 2 days a week, and that's what we're going to use the time space calculation for. Just want to give a couple of examples just to reinforce that concept. So exclusive use would be if, let's say, you have a separate entrance to your basement and it's only used by the families in your childcare business. So, or we said that storage room, right? Those are exclusive use spaces. On the other hand, a regular use space would be if you're using the family bedrooms for nap time, if you have your living room is your family living room, but then you also do some activities for the children during the week, maybe 1 or 2 days a week in the living room, that's a regular space. So when we look at time space, keep in mind that those exclusive use areas are going to be any expense having to do with exclusive use is going to be fully deducted, basically that's all about we're using it 100%, so that's all about the space portion of the calculation there. Now, the regular use space is based on that space, but also the percentage of time that it's used for business versus personal. All right. And what happens with this is you really do want to make sure that you have your documentation really well kept, that you have all of your measurements for your calculations for your time space well taken care of. So just keep that in mind, right? So we do know that given that concept, right, your expenses can either be fully deductible in your home business or partially deductible. So exclusive use areas are going to be fully deductible. And another example we have here, just because we really do want to differentiate between exclusive use and regular use. An example here, right, is if you're replacing a tile in the basement that's only used for childcare, that is an exclusive use expense. That means 100% of that expense would be allowable. If I installed a child-sized toilet, 100% of that expense would be allowable. My liability insurance, that's only for my business. 100% of that expense is allowable. Now let's look at the regular use space, right? Those are ones that are only partially deductible. And we have some examples here. So if I replaced all the windows in my home, using the time space calculation, I'll be able to determine what percentage of that expense I can take on my taxes using time space, right? If I replace my driveway, well, my driveway is used for parents coming to pick up and drop off children, but it's also used for personal use. That's considered to be a partially deductible business expense. So you want to keep that in mind there. And another example, we talked about, utilities and such, your home insurance, your homeowner's insurance. You don't get to deduct that 100%. You use time space to figure out how much of that cost of that expense you would be allowed to deduct for the business. All right, so these are the 6 steps, all right? They may look overwhelming and it's not. So keep in mind, right? I'm thinking about regular use and I'm thinking about exclusive use. And then I'm thinking about the time that the space is used, okay? So the time portion only applies to the regular use space. So as far as exclusive use, we're just talking about the amount of space that it takes. Regular use, we're talking about the amount of space and the amount of time, right? So just keep in mind that the exclusive use spaces, the more square footage you have for exclusive use, it does raise your time space calculation, because those are 100% of whatever percentage of your home they actually are. So let's look at these 6 steps that we can use for time space, all right? First thing we're going to do, we're going to determine the square footage of the regular use space. So we're going to measure all of the space that's used, all the spaces that are used in the business and also shared by family. I'm going to measure all of that. Now, I need to know the total number of square feet in my home, because after I've added all that regular use space, I'm going to divide that by the number of square feet in my home, the total number of square feet. That gives me a percentage. We're going to put that percentage to the side for a minute, all right? And then we're going to think about the amount of time that we use our home for childcare. And you basically will be adding up all of the hours, and you can add up time that is not spent directly in care of the children. It could be preparation time, it could be wrap-up time. As long as you are actively and correctly tracking that time, you can include that in your time space calculation. Now, in the year, there are 8,760 hours in a year. So after I've added up all of the time that I'm open, I'm going to take the amount of hours a year. I'll take the amount of hours that the business is open. I divide that by the number of hours in a year. That gives me a percentage. I'm going to go back and grab that percentage that I had for regular use, that one that we put to the side, and I'm going to multiply that with my new space percentage. That gives me another percent, right? That's that percent. What we're going to then do is put that to the side for a second, and we're going to go and take all of the exclusive space measurements, right? And we're going to add that all up and divide that by the square feet in my home. Okay, doing that then gives me a percentage. I take that percentage of the exclusive use space percentage, and I multiply it by that time space calculation percentage that I have, and that, or I should say the regular use time space calculation percentage that I have, multiply those two together, and that gives me my total time space calculation. Let's look at an example. All right, so let's say that a business is in a home that has 1,500 square feet. I measured all my exclusive space, it's 500 square feet. Okay. I measured all my regular use space, 700 square feet. This person is open, or I'm open 10 hours a day, but I also spend an hour before for setup, and I spend an hour afterwards for cleaning up, and I'm closed 2 weeks a year for vacation. What does that look like? All right. So first thing we're going to do in this instance, they kind of took the exclusive use and they put it to the side again. So let's think about this. So we already know that the home's total square feet, 1,500 square feet. We know that 700 square feet of that is used regularly, right? How do we get square feet? In every space, we measure the length of that space and the width by the width of that space. We multiply that to get our total square feet there. If you have weird little spaces, let's say little nooks and things like that, measure those separately. Add that up and then add that to the larger room. So you can measure closets. You can include all of that. You just have to measure carefully and add them to all of the room space that you have there. So by doing that, now that I've divided that regular use space by the total square feet in my home, I've come up with that first percentage that we are going to put to the side. We figured out our space percentage for the regular use space. Next thing I'm going to do is we're going to go in and we're going to start to think about that time again. I just jump back into regular use. Keep in mind, you do not measure your yard. You do not measure your driveway. That is not included in your time space calculation as regular space. You can claim and measure an attached deck. That is something that you could go ahead and measure and include that square feet in your regular use space. But we don't go out and measure our lawn or anything like that. So just kind of keep that in mind. All right, I've got that space calculation, I've got that percentage. Now I'm going to think about the time. All right, so what we want to do is we want to calculate how many hours the child care space is open per week. Again, time preparing, time cleaning up, even if the children aren't present. And then we're going to multiply that number, right? We figure out how many hours in a week. We're going to multiply that by the number of weeks that were open. All right. And let's say we were open 10 hours a day. We had an hour of prep, we had an hour of cleanup. So we're open 12 hours a day. Well, we have 5 business days in a week. So 12 hours by 5 days a week. That gives me a number. Then I'm going to say, okay, we were open 50 weeks. right? 50 weeks because we were on vacation for 2 weeks there. That basically gives me 3,000 hours, right? So if we look at the example there, I've got 3,000 hours worked, 12 hours a day, 5 days a week, 50 weeks a year, worked 3,000 hours. I'm going to take that 3,000 hours and I'm going to divide it by the number of hours in a year, which is 8,760. In our example, that gave us a percentage of 34.2%. I didn't say the percent before. For the regular use space square foot, the space percentage was 46.7. So what do? I take that 46.7% and I multiply it by the 34.2. So I multiply my regular use space by my time calculation. That gave me 16%. We rounded up there. 16%. That's for regular use. Next thing that I do is I go ahead and I take that exclusive use space, which was 500 square feet, divide it by the total number of square feet in my home, which was 1,500. That gives me a percentage. In this instance, 500 divided by 1,500, 33.3%. I take that and I add it to the number that I got for my regular space, time space portion of the calculation. So I take that 16%, I add it to the 33.3, 49.3% is my time space calculation. That's the percentage I'm going to claim for any expenses that are shared between my home and my business. So time space is not difficult. I want you to just think about these 6 steps. Think about setting a percentage to the side, and we're going to come back and use that and then move on to the next step. It's not difficult at all. So, all right. Switching gears, another tricky topic for businesses, especially because in 2023, many businesses did still receive the end of that different types of stimulus funding, pandemic stimulus funding. So keep in mind, any stimulus money that you received, it has to be counted as income. That is income. But if there were valid business expenses that you use that money for, you're going to take those expenses, right? So a lot of times it's kind of a wash, right? So you report the revenue, but you're going to deduct the expenses. But the next slide we're going to look at shows how the timing of those situations can be, is crucial to your tax burden. All right, so let's take a look, because we're going to talk about how this impacts our taxes. So what we have here is very, very straightforward. The first one, basically, I received $10,000 in stabilization money. Fantastic. That I have to report as revenue on my 2023 taxes. But I spent it all on $10,000 of allowable expenses in 2023. What does that mean? The two cancel themselves out. I have no additional taxable income. All right. Example number 2, let's say the business got that same $10,000, but they only used $5,000 with allowable expenses. So in that case, you have to either spend more of that money in 2023 or know that you're going to pay taxes on that difference of $5,000. The third case is something I want people to think about, especially with stimulus money, because keep in mind, with a lot of stimulus funding, we were able to use expenses prior to the year that we received the money, right? These pandemic stimulus funds, it often allowed us to go back and use the money for previous expenses. Well, in this example, the expense was from the previous year. I already used that. I used that expense on my taxes. I took it off my taxes for 2022. That's when I made that purchase or did that repair. I took that expense on my 2022 taxes. But in 2023 is when I actually received the $10,000 in stimulus funding. Well, what does that mean? For the tax year, for 2023, I have to pay taxes on all $10,000 because I already took the deductions in 2022. So you want to stop and think about that when you're, kind of running through your head what your tax liability is going to be. Keep in mind that stimulus funding really can affect what your taxes are going to be. because if you had expenses, didn't have enough expenses, or you had expenses in previous years, that is going to result in some type of tax liability. So this is the part that gets me very, very excited, right? When it comes to your taxes, usually the end of the year hits, right? So December 31st comes and everything that I did in 2023, okay, great, that involved my taxes, but anything else going forward, it does not affect 2023 taxes, except this one option. All right, so this is one thing that you can do that can mitigate last year's taxes, that can basically lower your tax liability for 2023. All right. Here's what it is. Consider contributing to a retirement plan that's set up through the business, right? So not a retirement plan that you've set up personally, but a retirement plan that was set up through the business. Now, setting one up, there are tax advantages. So I want you to kind of wrap your head around this idea. If you set up a retirement, such as we have here, our example is a SEP IRA. All right, so I set up a SEP IRA through my business. Well, my business makes contributions into my retirement plan, right? I've got my retirement plan through the business. Anything that I want to contribute from 2023, I can do it now up until April 15th and still affect 2023 taxes. Great, that money goes into my retirement fund. My business also gets to take that as an expense. So how amazing is that, right? It's a valid business expense, but I also put money towards my future. And I was able to then reduce the amount of tax I'm going to pay in 2023, because this is, an opportunity to lower that tax, make an investment in the future. It's all legitimate, and you can still do it now. You're running out of time, but you still can do it. So if you started to do your tax calculations and you realized, wow, actually the profit's a lot more than I thought, and I'm going to be paying a lot more taxes than I thought, that might be the time to think about, as a small business owner, opening a SEP IRA through the business, contributing money towards my own or my employees retirement, and taking all of that cost as a business expense. So this is the way that we can mitigate our expenses after the fact. All right. So let's say we have a situation where we've done our mitigation and now we found ourselves with a higher taxable profit. You know what? You had extra money. Yes, you're going to be paying taxes on it, but since we ended up with more money last year than we thought we were going to, we're going to pay taxes on it. But what should we do with that extra money? Let's just think about some things. This is a great time to pay down your debt, right? If you have debt, great opportunity so that it can save you money in the long run, so that you're not making interest payments, right? So we want to do that. We have some extra money at the end of last year. Let's create a reserve fund, all right? So that's a financial cushion. Every business needs one. Really, if you have higher profits, if your expenses tend to be steady, you're not expecting any kind of fluctuation in expenses, set aside some of those profits for a reserve fund, right? That can be really, really helpful with your cash flow. If you know that there are months that you are taking in less cash, your reserve fund can help you cover that with your cash flow. So that's something to keep in mind. Another great way to use that extra money, invest in business expansion. All right. So you've got this higher profit last year. Think about investing that in the growth of your business, right? So you could hire more staff, you could expand the physical building itself, launch new products or services, you could invest in marketing and advertising. So all things that could potentially lead to higher revenue in the future, right? And a lot of those things, if not all of those things, will be tax deductible for the year in which you had the expense. So I had that extra money in 2023. Let's put it towards some type of business expansion in 2024, increase my revenue, and get to take those often as business expenses. Now, this isn't so much about your higher net profit as it is a great practice to get in touch with something that you should be doing every single year. And that's at this point, right, when we're getting ready to file our 2023 taxes, we want to think about what the 2024 year looks like. Excuse me. And this is a great time for you to set in your calendar. I apologize. You want to set time for what's called the mid-year tax review. All right. And that's businesses should be doing a check-in somewhere between August and October. It's late summer into early fall. We still call it the mid-year tax review. But at that point, it's a really great opportunity to see where your tax liability is heading. Okay. So really what you can do is you want to take a look often at the amount of estimated taxes that you've paid so far. Think about, okay, let's say we're coming up on the end of quarter 3. This is how much in estimated taxes I paid. What do I think my revenue is going to be in, or I should just say my profit, what is my revenue minus my expenses going to be in quarter 4? How much tax did I plan on paying for that last quarter estimated tax payment? Is it going to be enough? Maybe I've paid so much in the beginning of the year and I need to pay less that last quarter, but it gives me an understanding of my tax liability, where we're at. Did I pay enough in my estimated taxes to cover tax liability? You have to keep in mind that by law, all right, you are required to pay at least 90% of your actual taxes for the current year, or 100% of your actual taxes from last year to avoid a penalty, right? So this tax review at the end of the year, it helps you plan how much more you need to pay in estimated taxes so that you're not paying any penalties. Estimated taxes are really important. They can save you from very unfortunate circumstances, and it helps you meet that requirement with the IRS that you are, going to be meeting your tax obligation, and that you are basically paying the correct amount of taxes. So, all right. And when you do that, when you're doing that review, you're looking at your revenue, you're looking at your expenses. It really is we talked about looking at your business health. Here it is, third quarter. Where are we at? Think about business health. What are we going to do? Are we going to tweak this? Are we going to tweak that? What can we do so that 2024, coming up this year, what is 2024? What are my taxes going to look like? Well, that mid-year tax review, maybe I can change course. Maybe if I'm spending too much money, maybe I can lessen my expenses. Maybe I can spend my money smarter. That's a great time. You're looking at your business health. If you need to change course, then's the time. Let's take advantage of the fourth quarter to do what we have to do to improve our business and make sure that we do not get hit with a tax bill that we weren't expecting. All right, so we've done all of that. Now, how do I get my taxes prepared? So it's a question that child care providers ask us often. How do I get my taxes prepared? Well, this is a brief list here of the pros and cons that compare paid tax preparers versus self-preparation, right? So you want to stop and think about what method is best for your business. Now, for a paid preparer, when you're looking for a paid preparer, somebody that you're going to be paying to prepare your taxes, you need to look for someone who's recommended in your network, right? We want someone who is familiar with childcare, especially home-based businesses, because there are tons of tax preparers that don't understand business use of home, that don't understand the allowable expenses, and can put you at a real disadvantage at tax time. So it does definitely help. What is a pro? You find a tax preparer that will work for you. You have a guide along the way. You have somebody that can help you. It can be expensive, so you want to kind of weigh the cost of that. But it also means that you have somebody that you can turn to for advice. So you can speak with someone and they can help you perhaps plan what your tax year is going to look like. You're there filing your 2023 taxes, and then they're going to walk you through some of the best practices for your taxes for 2024. So That's what using a paid preparer looks like. Now, if you're going to do self-preparation, sometimes, one, it's usually more cost effective, but there's an interesting thing with the IRS. So the IRS tends to audit online or computer-generated tax returns less frequently than they do those by a paid tax preparer. Sounds a little odd, right? IRS finds them to be more accurate, very beneficial for taxpayers. So have some confidence that you probably can do your own taxes. Definitely less expensive, right? The IRS is saying, hey, this can be more accurate. So many of these tax programs walk you through question by question. And I'm going to share with you a tool that you can use, a TurboTax tool, if you'd like, that you can use to learn about how things get entered in the TurboTax system there. But if you're using self-preparation, if you're doing it yourself, or let's say you're using a tax program of some sort, it can be more accurate, but a guide may be extra. So when you use that tax software, keep in mind that you often do have to pay for extra support. All right, so you just want to kind of keep that in mind there. And just because you did something last year one way doesn't mean you have to do it again this year this way, especially if you felt a little uncomfortable, because when you're working with a paid preparer, you need to find out, all right, are they qualified? So all tax preparers have to have a PTIN, which is an IRS preparer tax identification number. So they have to register with the IRS. So you're going to want to ask for that number in advance just to know that they are allowed to prepare your taxes. The IRS has something on their website where you can basically verify a preparer's PTIN and their credentials. You want to ask them about what kind of training, right? So do they have professional credentials? There are enrolled agents, which are licensed by the IRS, certified public accountants, attorneys. They all work as tax preparers, right? Many different types of business and education work as tax preparers. But there's also what's called the annual filing season program, and often qualified tax preparers are participants in that. You'll also find bookkeepers, certified financial planners. They all become basically enrolled agents, or in some way they've gotten their PTIN and they have credentials at that point there. If you go to the IRS website, you can search for qualified tax preparers. It doesn't break it down by industry, right? Which comes to the next question. Have they worked with childcare businesses before? Do they understand your needs, right? So experience counts when looking for a qualified tax preparation service. So if we're going to use a paid preparer, we want to make sure that they have knowledge that's relevant to your specific circumstances, right? Do they work with other childcare providers? What is their understanding of business use of home? Things of that nature there. Speak to them and see, are they doing continuing education also? Are they up to date with the state taxes, not just the federal? So you want to basically talk about all of that. And then, all of this is crucial, but so important is, can you get a copy of your return, right? So you need to get a hard copy of anything that a paid preparer has filed for you, and they need to include all of the documents that they're filing, and then all of the records you gave them. That needs to come back to you in a neat little package. You are entitled to that. You'll see if you're doing taxes yourself and you're using an online, some type of tax program, you just print all of that out and keep that hard copy. But a lot of times with tax preparers, it's hard to reach them outside of tax season. And if that's the case, if they don't give you a copy of your return upon filing, when they've met with you and done the calculations and ready to file, you don't want to leave without that, or you don't want any length of time to go without them having given you that. So you are entitled to that hard copy. You want to hang on to it. There are many things in life that require us to either submit our taxes or refer to our taxes. Have that hard copy. Another suggestion would be, once you have that hard copy, take pictures, scan, store it digitally in your computer, keep a backup of that copy, because what should happen if you aren't able, you lose the first copy and your tax preparer doesn't have anything to share with you. And again, get back every document that you gave them, all your 1099s, receipts, proof of payment, get all of that back, right? Keep all of that for at least 4 years. So that's what it looks like if we're working with a tax preparer. Now, what if we're doing self-preparation? And these links, I'm going to, again, put the Civitas strategies. I'm sorry that I didn't do it before, but I'll do it as soon as we get to the question and answer period. You'll see on the Civitas site, this is an online guide. It helps you do your own taxes using something like TurboTax. All right. So basically, this will walk you through the process. This is the link to the TurboTax. There's also, you'll see here on the screen, there's a link that's www.weca-cses.com. There are tons of guides that our friends in Wisconsin have posted on their site there. So all these tools are free and easy to use. The TurboTax guide is great, honestly, just like the homegrown guide. We're gonna share that link with you there. So the homegrown guide link will be in the chat as well on the Civitas page, but there's something else that's called the Confidence and Quality Tax Rubric app. All right, so it was developed working with actual family and center providers, basically looking at their taxes and to help them understand, not only the owners, but also tax preparers, understand specific tax regulations for childcare. So really, the rubric walks you through a lot of the questions a lot of the answers you'll need for your Schedule C. So what do we do with this app? We use it for last year's taxes to assess what, in this instance, what did 2022 look like? I pull out my Schedule C, I go to this app, I answer questions based on what I did in 2022, and it's going to give me some ideas and some hints and some help for 2023. So super, super easy to use. It's free. I'll have that link. Keep in mind, the information that you share with us, we don't keep it. So after you've done all the answers, you give us your email address, we send you a report based on all of your answers. You could take that to your tax preparer, but we don't keep your results. So if you needed that to see that again, you'd have to go through and answer the questions. If you lose your copy or you don't download one, you would go and you would repeat the questions, because we don't keep any of your information. Here's the QR code on the screen for that. Again, the link will be in the chat. All right, so we're drawing to a close. I told you it was going to be longer than an hour there. So it's vital to reflect on all of what you need to do, right, in terms of accurately reporting your revenue, accurately gathering and reporting your expenses so that your tax liability is correct and you don't have to pay taxes that that you're not required to there. Whether you're going to do your taxes solo or you're going to enlist a qualified professional, it is essential that you take advantage of some tools, all right? So that Confidence and Quality Tax Prep Rubric, that which is the app, the Homegrown Childcare Guide, cannot recommend that enough. The TurboTax, keep in mind that all of these are meant to help you with education for your taxes. It's not meant to be a substitute for a qualified tax preparer. So if you are not, if you have any questions, if you're unsure about anything, by all means, this is not meant to take the place of legal or accounting advice. So I want everybody to just kind of keep that in mind. But let's just see here. I look like I have a question here? Oh, where do we go? This is from Athena. So where do we go to start a retirement fund, and how do we begin that process? You'd be surprised how many of the financial institutions that you're currently working with also help you go forward with setting up a retirement fund. We also know that one of the most popular, not that I'm recommending them, but many people who work within my company have had a lot of luck with Fidelity, right? So look for for organizations like Fidelity, for your own banking, credit unions. There are so many different ways that you can approach an organization that can help you set up those retirement plans. And remember, we want to set them up through the business so that we get the advantage of that contribution being tax deductible for the business. Thank you. I am so this is from Sandra. So hello, my question is, I am a for-profit center, and I was told by my CPA that the grants we got during COVID, we have to pass through to my personal taxes. So Sandra, they're telling you not to claim that as income. Do you want to come off of mute? Just kind of curious if they're asking you not to consider it to be revenue for your business. Is that, or you can answer me in the chat if you feel more comfortable. I'm not sure why. I was just wondering if they gave you any kind of reason. I'm sure there. Let me just see, Sandra, if I can take you off mute if you're not able to come off yourself.
Can you hear me?
I can hear you now, Sandra. Thank you.
Yes. So I was hoping to claim it on my business because it would make my personal taxes revenue higher. But she said, no, you don't do it through your business. You do it through your personal. It has to be passed through. And I just didn't understand that. That just did not make sense to me.
That doesn't make sense to me either, Sandra, because you receive those funds as business funds and you're taking those expenses as business expenses, right?
Exactly. I told him it didn't come to Sandra Beta. It came to Sow & Seed, which is my center. It came
right.
to there. It was a grant that I had to fill out for the center and give the center expenses and everything else. But they passed it through my personal, and I'm still struggling with that a lot.
So weird. You know what? Actually, let me just in the Q&A here, I'll put it in the chat. Sandra, what I'm going to do is put my email address in here, which is Jennifer@Civstrat. That's the abbreviation for my company. Would you mind emailing me that specific question? Yes. And I will get an answer for you.
I'm not receiving any. There you go. Thank you.
Yeah, sorry, it was just me. I'm a very slow typist. So there, but yeah, if you don't mind sending me the question, one, so it triggers it, and two, so you and I can connect about that. I honestly have not heard it. We have a tax, I never guess. All right. So we have a tax professional. The owner of our company is a tax guru, I should say, a tax whiz. He's not a licensed professional. But he will give me some guidance about that. I honestly have not heard that, and I have been coaching on taxes for quite some time. I've not heard anybody claiming any of the stimulus funding for their business with their personal. So, yeah.
So also, so does your business do childcare taxes?
We don't. No. Yeah. So I'm not sure, if you're able to, for our sponsor or the organization that's helping us here today, perhaps they have a list of, and we're going to show their next, I'll just jump to that. You may want to reach out and just see if they're keeping any type of list, are they doing anything regarding tax preparation. So, what we do is I review someone's previous year taxes and then meet with them to talk about their tax strategy for 2023, but we're not licensed tax preparers. We don't offer that service. We do know how difficult it is for you to find someone who specializes in childcare.
Yeah, thank you.
Oh, you're very welcome. You're very, very welcome here. Looks like Paulina has a question. Do I still have time to set up the SEP IRA? Yeah. So you have until April 15th. So we're running out of time. But if you set up the SEP IRA through the business we've got until the tax deadline this year, that basically reduces your 2023 taxes. So, and you get to make that contribution to your retirement, Paulina. So, you can still do that, right? You say that you're going to be filing your taxes in 2 weeks. Reach out to something like Fidelity, your bank, credit unions, and say you want to set up through the business, and that's what's key, right? Through the business, the SEP IRA, and that way they will help you that way, get you set up. on there. It looks like Maria is asking, could we send the presentation by email? So what will happen is that you see the organization's website, they are going to be posting the recording. So they will post the recording. They are not going to be sharing the actual slide deck. So they will do that there. Oh, here we have a nonprofit. Carolyn did not pay taxes there. So, but thanks, Carolyn. She's jumped off. So she's a nonprofit. Let's just see here. What else I have going on in the Q&A here? Yeah, so, again, Athena, right, starting that process, you want to get in contact with a very legitimate financial source. We just happen to know that Fidelity is an organization, a business that a lot of small businesses work with. They're very, very familiar with working with small businesses. So basically what you do is you go to them. They're going to ask you for the relevant business information. SEP IRAs are either no cost or very, very low cost to set up. So there aren't going to be a lot of fees for your business. And it's relatively easy to do. You just need, and SEP IRAs are through businesses, but you just want to go in there, explaining that you are setting up a retirement fund through the business. And the reason that you're doing it is so that you can receive your own personal a retirement through the business and then take it as a business deduction. So you'll just want to explain to them what that looks like. All right, I'm going to throw the Civitas. Oops, I'm sorry, I've got something here. Paulina, to claim utilities for my home daycare business. Yeah, I have to create that calculation. So you have to do anything that is shared, your utilities, you have to use the time-space calculation. So any of those shared expenses, you calculate, you do all that measuring, you take that exclusive use space and put that kind of to the side, measure all the regular space that's shared between the home and business, right? We're going to measure all of that. We're going to divide that number by the square feet in our house, gives us a percentage. We say, okay, percentage, you're going to sit over here. And then we're going to figure out the amount of hours that we're open in a year. And what we do is we take the amount of hours we're open in a year and we divide it by 8,760. That gives me a percentage. I'm going to multiply those two percentages together. Boom, I've got my regular space, time space portion. Take the percentage of the exclusive space, right, which was exclusive space divided by the amount of square feet in my home. That gives me a percentage, and then I add those two percentages together. You're going to have to use that time space calculation for anything that's shared, any allowable expense. So you have here for windows. Yes, you could replace windows in your home. If they were only replaced in a room, if they were replaced in a room that was only used for childcare, okay, that's an exclusive space expense. But if you replaced all the windows in the home or partial windows in the home with spaces that are shared with your family, you're going to have to use the time space calculation. And that is on your 8829, your business use of home form. There's a place there for the time space calculation. And then that's how you calculate that portion of those expenses going forward that you're going to then put. It gets moved over to your Schedule C. I'm just taking a look here, kind of scrolling through. Let me put that in the chat before I forget. Bear with me, everybody. Going to be just a second. Again, what did I say? I'm just one person here. I'll stop sharing. Well, I'm going to leave this up here. I'm going to jump to the next slide. This is our website. This is not the link that I'm going to be putting in the chat. But this is our website if you'd like to go to our website. But we also are the stewards of Tom Copeland's blog. So I'm going to, that's my YouTube, I'm sorry. I just was at Tom Copeland. So you can go to tomcopelandblog.com and do that. But we also have our YouTube channel and over 600 videos on our YouTube channel. The channel name is Civitas Strategies. So if you don't happen to use the QR code, by all means, you can just look us up on YouTube and find all of these amazing videos. And then, again, because it's just me and I'm going slow. All right. Hang on just a second. Why is it not letting me make this a link? Oh my goodness. 1 second. What I'd like you to do then is to go to the website. I apologize. You're going to go to CivStrat. I'm putting this in here. It did not, for whatever reason, I apologize, did not come across as a link, and it's not letting me make it a link. So what you're going to do is go to the CivStrat website. So CIV as in Victor, Strat, STRAT.com, and you will see a little up at the top, tax season resources. Click on that. You're going to see all of the different tools that we talked about today. Homegrown Guide, TurboTax tool. What else we've got? Just the quality, the rubric, the app. It will, you basically everything that you could need that we talked about today will be in that site there. So I do apologize. I did the wrong thing. So I'm quite sorry about that. Do we have any other questions? I'm just going to see it. Can I see? Anybody have a hand up? I don't see any hands up. So we actually then, we are done. I'm going to just go back to the client site. So hang on just a second. Oops, there goes my share. All right, folks, let me just. All right, so there we go. So this is, again, this is the website where you can sign up for, they have coaching, all sorts of provider resources, all different guides that Civitas has worked on for them. Bunch of tools for your business. Please, please, please do go to the website and find out more information. It's also, they will have a link to this presentation.